Welcome back to the Deep Dive. Today we're tackling probably the biggest question on everyone's mind. Is real estate still a good investment here in 2025? We know you need smart insights, fast. So whether you're looking at your first property or, managing a large portfolio, we're getting straight to the core strategies.
Exactly. Our goal today is really to walk through the key forces shaping the market right now. We'll look at the upsides, sure, but also weigh them against the very real challenges out there. You've got these high interest rates sticking around, inflation that just won't quit, and how people want to live is changing fast. It's a whole new ballgame this year.
Okay, let's unpack that. Starting with the 2025 market snapshot. You mentioned interest rates. It seems like the elephant in the room. The cost of borrowing money is just huge right now.
It absolutely is. Central banks they're determined to keep rates high to fight inflation. Compared to the last decade or so, borrowing is just much, much more expensive.
And for the average person trying to buy a home,
Yeah.
that means serious pain, right?
Yeah. Precisely. Higher mortgage rates mean much bigger monthly payments. It pushes a lot of first-time buyers right out of the market. That slows down demand overall. It's basically putting the brakes on that crazy price growth we saw in some of the really pricey markets. It's almost like things have just seized up financially.
Okay, but here's where it gets interesting for you, the investor listening. We keep hearing this high rate environment could mean opportunities, less competition maybe.
Yeah.
But is that real when your own financing costs are so high?
That's the tension, isn't it? Investors are definitely facing higher borrowing costs, and that hits your immediate cash flow, no question. But because the market's adjusting to these rates, things are shifting. We're seeing fewer bidding wars, more rational deals. If you've got cash or maybe some creative financing, there might be chances to negotiate better prices, especially with sellers who really need to sell.
And negotiation angle is key. Okay, moving on. Demand shifts. Remote work changed everything, didn't it? People moving out of cities.
Oh, definitely. The trend is clear. We're seeing sustained demand, price stability, too, in suburbs and even some rural spots. People are looking for affordability, more space, and that migration creates huge potential in these sort of fringe areas, places that maybe got overlooked before. You see it a lot in the Sun Belt metros, for example.
But you have to mention the exceptions, right? Like some big urban centers are still super hot.
Yeah.
Thinking Seattle, maybe core parts of New York.
Right. Those are the places that sort of prove the rule. They have huge barriers to entry, not much land to build on, strict zoning, tons of high-paying jobs clustered together. So even with high rates, there's just not enough housing to go around. That keeps prices up and demand strong. It really shows you can't just look at national numbers. You have to zoom in locally.
Got it. And the last big force, inflation.
Yeah.
That hits everything from building new homes to just fixing the roof, right? It digs into your profits.
Yeah, inflation bumps up the cost of materials, labor, everything. So, new construction gets pricier, which pulls up the price of existing homes too. And it means you, as an owner, have to budget more for basic maintenance, and definitely for those nasty surprise repairs.
But isn't the classic argument that real estate is actually a hedge against inflation? Like, it protects your money.
That's the traditional view, and there's a solid reason for it. Real estate is, it's a physical thing. It's tangible, and it's often leveraged with a mortgage. So as the cost of everything else goes up, building materials, replacement costs, the value of your property tends to rise too. Plus, you're paying back your loan with dollars that become worth less over time. For someone holding long term, that appreciation is a really important buffer against inflation eating away at your wealth.
That makes sense. Puts the challenges in perspective. Okay, we know 2025 has headwinds, rates, costs, but let's shift gears. Talk about the fundamental reasons real estate still makes sense for building wealth.
Well, first and foremost is long-term appreciation. Yes, things are volatile short-term, but historically, real estate values go up over time. The key is investing in markets with solid fundamentals, like job growth, population growth, things like that.
And maybe the most appealing benefit, especially now, is getting that steady rental income, that cash flow.
Exactly. Housing demand is high, and because it's so hard for many people to actually buy right now with these rates, the rental market is strong. You even see people who'd prefer house renting single-family homes because they can't afford to buy one. So demand is up across the board, apartments, houses, providing that reliable income stream.
And it's not just income. There's the portfolio stability factor, too.
Yeah.
Real estate helps diversify, right? It doesn't always move with stocks.
It's crucial for diversification, yeah. It's a physical asset. Its returns usually don't track perfectly with stocks or bonds. That lack of correlation helps lower your overall risk. If the stock market's going crazy, your real estate might provide a steady anchor, offer stability. Plus, you can diversify within real estate itself, residential, commercial, industrial. Lots of options.
Okay, now let's get into the really strategic stuff. Taxes. Sophisticated investors love the tax advantages, and we mean beyond just deducting property tax.
Right, this is where it gets powerful. Yes, you deduct mortgage interest, property taxes, insurance, repairs, all that. But the really unique one, the big one, is depreciation. Depreciation is basically a write-off you take on paper for the building wearing out over time. It reduces your taxable rental income even if the property's value is actually going up. It's a non-cash expense, which is huge.
And for investors really trying to make the numbers work with today's high interest rates, they're looking at ways to, accelerate that depreciation, aren't they?
That's exactly right, especially for higher net worth investors or those managing larger portfolios. They use strategies like cost segregation. Essentially, they hire engineers to break down the property into its components: carpets, appliances, landscaping, fixtures, things that wear out faster than the building structure itself. By assigning shorter depreciation lives to those items, they can take much bigger deductions up front in the early years of ownership. This significantly lowers their immediate tax bill, and when high interest payments are squeezing your cash flow, maximizing these tax benefits becomes really critical for the overall return.
That's a powerful lever. Okay, we've painted a pretty positive picture of the advantages, but now the reality check. Let's pivot back to the risks. What do investors absolutely need to watch out for in 2025?
Well, risk number one is still that high cost of borrowing. Higher rates mean lower net income from rentals, simple as that. And because it's harder for buyers to qualify, fewer people are moving, fewer transactions are happening, that can definitely lead to price drops or at least stagnation, especially in markets that maybe ran up too fast.
And if the market does slow down significantly, doesn't that trap the investor? Real estate isn't like selling a stock.
It's not liquid at all. That's a major risk. If you bought near the peak in, say, 2021 or 2022, your purchase price is high. If rates haven't come down much, selling now might mean taking a loss or just being forced to hold on longer than you planned. And you have that market uncertainty. Things can change locally. A big company leaves town, new regulations come in that can hit prices hard in one specific area, even if the national picture looks okay. It just underscores you have to do your homework on the specific location.
Good point. And finally, let's not forget the actual work involved. Property management. This isn't just buy and hold, click a button investing.
Not even remotely. You are essentially running a small business. There are ongoing costs for maintenance, repairs. There's the time you spend dealing with tenants or the cost of hiring someone else to do it. And then there are the big unexpected hits. A furnace dies in winter, a pipe bursts. Those can wipe out your profits for months, even a year. Plus, if you hire a management company, that's typically 8, maybe 12% of your gross rent right off the top. And you always have to budget for vacancies, times when the property sits empty.
Okay, so it's complex. High costs, intense management, market uncertainty. Given all that, where should a smart investor be looking right now? Where are the pockets of opportunity?
I think you need to look towards emerging neighborhoods. Areas that are sort of on the edge of already successful places. Savvy investors hunt for signs of future growth, maybe a new transit line going in, big infrastructure projects, zoning changes that allow for more development. Look for ripple effects.
Can you give a more current example? Beyond the classic Seattle stories, where is that happening now?
Well, think about areas around major job hubs, maybe in the Sun Belt, where growth has been so fast it's pushing people further out into the suburbs or exurbs. We're seeing some interesting returns in places outside cities, like, say, Dallas or Phoenix, places now attracting corporate relocations. These spots might offer better cash flow right away because you can buy cheaper, but they also potentially benefit from that long-term wave of population and job growth coming their way.
Okay, what about commercial real estate? We hear offices are dead, but is that the whole story? Is money moving elsewhere in CRE?
Yeah, the commercial market is really splitting. Traditional office space is definitely facing challenges, high vacancy rates in many cities. But other parts of CRE are doing quite well. Think industrial and logistics warehouses for e-commerce. Data centers are huge. And there's also the rise of build-to-rent communities. These are basically entire neighborhoods of single-family homes built specifically as rentals, managed like apartment complexes. They tap into that strong demand for houses, but offer professional management.
And you mentioned adaptive reuse earlier, mixing uses.
Yes, exactly. There's a lot of focus now on properties that can blend things together. Maybe apartments upstairs, some retail or cafes on the ground floor, and maybe flexible co-working or smaller office spaces mixed in. It caters to that desire for a live work-play environment, all walkable, and for the investor, it diversifies your income streams from that one property. Less risky than just relying on office tenants, for example.
And one more trend, sustainability. Green buildings. That seems to be getting huge traction.
Huge, and it's driven by both what tenants and buyers want and by the bottom line. We're talking more than just solar panels now. People are actively looking for buildings with green certifications like LED or Passive House. These places often command higher rents or sale prices. Why? Because their operating costs are much lower thanks to better insulation, efficient heating and cooling, smart systems. Lower utility bills are a major draw, especially when everything else feels expensive.
Fantastic points. Okay,
But
let's try to boil this all down. Before we wrap, what are, say, the 3 absolute must-do checks for anyone considering a real estate investment in this market?
Yeah.
Number 1,
hyperlocal market knowledge. You just cannot rely on national headlines or averages. You need to understand the specific supply and demand in the exact neighborhood you're looking at. Is it a mature, supply-constrained market like Seattle, where you're betting mostly on appreciation? Or is it a fast-growing Sunbelt city where cash flow might be better now, but you need to worry about developers building too much supply down the road? It varies block by block.
Okay. Number 2.
Deeply, truly understand the cash flow potential. This is critical for rental properties. Cash flow isn't just the rent you collect. It's what's left after you pay the mortgage. Property taxes, insurance, set aside money for repairs, and account for potential vacancies. That's your actual profit. Look for properties near reliable demand drivers, universities, hospitals, big employment centers. But you have to run the numbers conservatively and balance that immediate cash flow with the potential for long-term value growth.
Makes sense. And the final critical check.
Don't underestimate the hidden costs of property condition. This trips up so many investors. Always, always get a thorough professional inspection, especially with older properties. They might look okay on the surface, but could have very expensive problems hiding old wiring, plumbing issues, foundation cracks, mold. You absolutely must factor the cost of necessary repairs and capital improvements into your purchase price before you buy. Otherwise, what looked like a good deal can turn into a money pit very quickly.
And navigating all this complexity, especially with high borrowing costs, who's your indispensable guide?
An experienced real estate agent, specifically one who focuses on investment properties in your target area. They bring that crucial local insight. They might know about off-market deals or those emerging areas before everyone else does. And they can help you navigate the tricky lending environment and negotiations in this market. They're invaluable.
So wrapping this all up, what's the bottom line from our deep dive today? It seems clear. Real estate can still be a very good investment in 2025. But success isn't guaranteed. It really hinges on smart strategy, navigating these high rates carefully, and being really savvy about where demand is heading geographically.
That sums it up perfectly, which brings us back, really, to the core strategic choice investors face right now. It's a trade-off forced by the current market conditions. Considering how much high interest rates drag on your immediate profits and how demanding property management truly is, what should you prioritize more heavily in 2025? Is it locking in strong immediate cash flow just to make sure you can cover that expensive debt? Or is it focusing on maximizing those long-term backloaded tax benefits you get from things like accelerated depreciation?
That is the crucial calculation, isn't it? Immediate survival versus long-term optimization. A really important question for you to think about as you plan your next move. Thanks for joining us for this deep dive.